Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would be the mayor, the governor in the great state of real estate of Texas, Mr. Michael Becker, but he is on our due diligence assignment. So we're blessed to have the professor, James Eng, sitting in the podcast today. James, how are you?
Hey, Paul. Thanks for having me.
What is going on in the Old Capital world these days, James?
Well, we're going to squeeze in one more bus tour, it looks like in May, and then we have the conference coming up. We're not going to put you on a bus in July. Maybe August, but not July. So.
That's right. What is the purpose of the bus tours? Because a lot of people ask me, is that what do you guys talk about? What are you promoting? What are you selling? And I'm like, nothing. We're not selling or promoting anything. We're bankers trying to explain to people before they put $10 or $100,000 into something, understand what the hell you're talking about and how all this stuff works.
I think we're still trying to figure out who the best audience or the best way to do the bus tour. But imagine you wanted to come to Dallas and, Paul picked you up or I picked you up from the airport and we said, hey, we're going to drive you around DFW and give you an idea of the submarkets, the idea of a class A, B, C property out there, and then basically just took you into all these units. But then at the same time, you got to meet the owner, or you got to meet the broker who was selling the deal at the same time. So I think the combination of those two things, but instead of just doing it with maybe one or two investors and you being in the car, we just rent a bus and put you on the bus with 30 or 40 other investors and go along for the same ride. This will be our third one this year, and people didn't show up, then we would probably stop doing it. So people keep showing up, so we're going to keep doing it.
And it's for investors all over the United States. They just don't have to be in Dallas or in Texas. If you live in Florida or you live in Philadelphia or you live in Phoenix, and the math is the same in your hometown as it is here, but you just get to hang out with us a little bit and kind of see how bankers look and structure these transactions. So we're not promoting anything. We don't want you to invest, period, at all. This is not what this is. We don't want you to meet anybody, but we want you to kind of understand the basics about what is going on. We're not selling you books and tapes. We're not selling you a mentoring class. We're just telling you what, if you are my brother or my cousin, would be what you should be looking out for if you were to invest in this. And we think for $100 to come on in, I'm not going to give it away for free, but I'm going to have you just come out, because there is a cost for us to do it, but we'd rather have you be part of this and understand it before you got into it, that you just gave somebody $50,000 or $100,000 without you really knowing what the hell's going on. That wouldn't be fair for you. So come on in and spend some time with us and kind of understand really what's going on. So the next time, if you've missed it this time in May, it's going to probably be the month before we do our conference. And James, talk a little bit about our conference, because I think that's the premier event in Texas.
Yeah, I think, when we've been to a lot of conferences the last 2 weeks or so here in Dallas, and you walk in, you look around, and you're like, I'm not sure if any of these people do anything in multifamily. But what we try to do at our conference is really focus in on the guys who are really buying the B and C properties, and potentially, as they scale up, maybe an A property here or there. And so a lot of the owners, operators in the DFW, Austin, San Antonio space will come up to our conference, and it's almost like a family reunion, but for multifamily guys in Texas to some extent. So, and I think what's different is a lot of the guys at some of these other conferences, it might just be an employee of a big REIT or employee of some sort of corporate entity. There's some of those guys at our conference, but not really. Most of the guys, they are investing their own money. They are raising the money. They are at the property They might have third party, but some of these guys are self-managing these properties. So it's more of a hands-on conference, and a lot of people there, they do this day in and day out.
Everybody loves this conference. So if you are thinking about getting into multifamily, and if you are in multifamily and you just want to learn a little bit more, or you want to network and you want to be part of what's going on here in Texas, of just looking at the growth of what's going on, come see us. Go to the oldcapitalconference.com website, oldcapitalconference.com. Come see us in the fall, and I think you'll be glad that you did. Today in the podcast, it's kind of a hodgepodge. You're sitting in a conference call. You're sitting in a Starbucks meeting with James and I, and we're just sitting here talking a little bit about what's going on. So I was at the GREA conference last week with James and some of the Old Capital folks. There must have been, how many people there, James?
A couple hundred people. Yeah, it was a good group out there. Yeah.
Good size conference. GREA is an independent investment advisory firm that sells multifamily properties in the Texas area. They're an independent company that also in about maybe 9 or 10 different cities that they have operations, but I think they do a very good job. Todd Franks and Mark Allen were our hosts. I spoke at the event, and I spoke a little bit about distress assets. And I thought we'd spend a few minutes talking about distress assets, what my feeling and thoughts were, and then we'll talk a little bit about, what we see for changes perhaps in underwriting and just kind of the pulse about what's going on. So I'm going to kick it off to James. And James, what was your take about that conference with GREA?
Yeah, I'm trying to remember exactly. You had a wide range of folks, whether it was attorneys up there with you, and then also sort of the asset managers for lenders. I think the biggest thing, or the biggest takeaway from that panel was that each one of these deals is very unique. So depending on whether that lender has an appetite for taking deals over, or they just want to kick the can. So I think figuring out, because we've seen some deals where, let's say the loan balance is $20 million and the lender thinks they can sell it for $21 million. They're not going to extend you. They're just going to foreclose, and they'll just sell the asset for $21 million and capture that $1 million. And so they are making it more onerous on the borrowing group to get that extension, right? Whereas that same $20 million loan, if they think the property is worth 15, they don't want to take it back and take a $5 million loss. So they're giving that borrower as much time as possible to keep kicking the can for another year. And as long as the borrower keeps making their payment, then let them go. I'm not going to step in.
So up on the stage was myself. I was kind of giving just a general overview of what we're seeing in the market today on doing new transactions, kind of giving a pulse about what's going on. And then we had probably 3 advisors. One was two were attorneys, and one was a lady that works in the CMBS CLO business, CMBS commercial mortgage-backed security business, and then collateralized loan obligations. And that's where if you have a non-recourse bridge loan, you would go talk with her, or you would talk to these 2 attorneys, and they would kind of help you kind of discover a little bit of what's in your loan documents. And then the other 2 gentlemen that were on the stage with me, where one was a balance sheet lender. One was a large bank here based in North Texas that has operations throughout the state, multi-billion dollar. And we were talking with him. He was a workout specialist. And workout specialist is the property goes into special, they call it a special asset, which means that the property is starting to show problems before it gets foreclosed upon. And then he makes a decision whether that they should foreclose upon the property or structure the transaction differently to keep it out of foreclosure. The other gentleman was another lender. He wasn't a balance sheet lender like the first lender was. Again, the balance sheet lender it was their money. They take money in from deposits, they lend it back out in the community. This gentleman was a CLO or a non-recourse bridge lender. So they're not a balance sheet. They don't take in deposits. They just lend money from other investors, and they have certain criteria of what they have to do. And remember, when you sign some of these loan documents, and what you don't understand sometimes is that back in 1985, 1975, 1965, 1955. When you lending money to individuals or companies or commercial real estate, all those loan documents were pretty much the same. Everything was the same in the loan documents. So if you signed on a loan document, you knew exactly what you were getting into. And then in the late 1990s, going into 2000, those loan documents started to change and they became more like securities. You started to borrow money, not just from a bank, but you could borrow money from other investors. And so that was the next generation. So that was generation, 1.0. Today we're at 2.0. And that is the last set of loan documents. They came out in the last like 5 years or so, and they're very complicated. And so if you find yourself with a problem that concerns that you're not able to pay, you're going to need to talk with an advisor, an analyst. You need to talk with people that look through these loan documents, because what these loan documents were back 15 years ago are not what they are today. Every transaction is like a fingerprint or a snowflake. They're all different. Every set of loan documents per the asset itself is all different. And so you really need help of kind of understanding a little bit about what's going on. And that's what we kind of talked about on stage. James, what are other things that we talked about?
Yeah, I mean, the hard thing when talking on stage in front of 200 people is that you really can't get into specifics. And that is what's hard, is that everyone's talking in generalities. And the way deals are getting cut and the way deals are being put together is that you have to know, number one, who the lender is. Number two, what that lender's appetite for taking over the deal is. And then number three, you might have to figure out, is the seller in control of this deal or is the lender in control of this deal? When you listen to Walker & Dunlop, they're a bigger Fannie Freddie shop. They've got like 8 loans that are in default, so they don't care, right? Compared to out of 3,000 loans, they only got 8 that are in default. But, you listen to Arbor's call. Arbor had like 950 million that they had to modify this past quarter. In one quarter, 950 million in loans. There's just some shops that they're fine modifying loans, switching it to maybe a 5% current and 2.5% accrued. And, one of the advisors on the panel mentioned just sort of like a cash flow mortgage, which I hadn't heard that term in a while, but essentially whatever cash there is, that's going towards the loan. And no money's going towards distributions, no money's going towards anything else. Some lenders are willing to accept that, but other lenders, let's say it's in a CLO or CMBS loan, the investors are expecting to get the full payment. And if you're not making the full payment, then they're going to kick you over to special servicing or they're going to foreclose on the asset. And so I think it's really important to understand, if you have a loan out there and you're working through the bridge loan extension, then, making sure that you've got the right guy or right people on your team to sort of work through that. Because if, like, we had a deal come up where the seller had an offer to sell a deal above the loan balance, but the lender didn't care, they took it back anyways, right? Just being on top of your extension, your maturities, so that does not happen to you, because we're seeing more foreclosures happen, I would say, this year than last year. So more guys are just moving forward on some of these foreclosures.
Yeah, we talk about distressed assets, James, in that conversation, but I don't want to scare people. I mean, you tell me what you think about the entire multifamily market. Is it all distress or is just a little bit of distress? What is your general sense of the market itself?
Well, it's hard to, if you look at transactions that closed in the first quarter or even a little bit here in April and May, if someone doesn't have to go right now, then they're not necessarily selling. It feels like every deal that you look at, you look up the seller and you're like, well, they had a bridge loan that matured last year or 6 months ago. It feels like there's more distress in the market. And then also we're seeing deals where a lot of deals had to close with non-recourse bridge because it couldn't qualify for agency, right? So it's sitting at 80% or 85%. And so you're having, it feels a little bit more like distress is out there, but there's a lot of guys who are just sitting on Fannie and Freddie fixed rate loans and they're still on the beach because they're not selling right now, because there's really no reason to, unless there's some sort of partnership dispute or you've owned the deal for 10 years and you're done with the deal. We're not, we're seeing more of the distressed stuff pop up and we're talking more about it. But there's plenty of deals where people have owned it for 7, 10 years and it's just time to go. And those deals are getting financed just normal Fannie and Freddie. And people are paying top dollar for those deals, especially on the A side right now. And so a lot of deals in the first quarter were on the larger side and on the A side, institutional stuff.
We talk about hodgepodge today on our discussion with the professor himself. Let's talk a little bit about underwriting and some of the changes that we can talk a little bit about with Fannie and Freddie. James and Ricardo sat down with 45, 50 general partners last week, and they kind of went through just some underwriting changes to the guidelines themselves, things that were helpful that, let's say, Fannie Mae or Freddie Mac is trying to do. So, James, can you kind of talk a little bit about high level and some of the expectations for people?
Yeah, I mean, we'll start with Fannie and then we'll go over to Freddie. But, Fannie is, they're still going through, I think, a little bit of the growing pains of the new administration. And then it seems like when the 10-year treasury is high, nobody submits anything to them. But then, 10-year treasury goes below 4, and all of a sudden they have a huge mountain of requests. In order to get sort of your hard quote from Fannie, it's taken about 2 to 3 weeks on a lot of these deals, especially acquisitions. But we did get a quote back last week and it was less than a week. So
what is a hard quote? What does that mean for somebody who's never done a loan?
Yeah, I mean, so Fannie has, they have 20 to 25 people or lenders who have a license with Fannie Mae. And they can do the deal by themselves, but, they maybe can do with 1 year interest only, and they really don't get any waivers on pricing or on some of the other things. Let's say you need a waiver on insurance or you need a waiver on the borrower or the property or something. So there's almost in almost every case, you're going to have to go to Fannie Mae for a waiver on IO or pricing or one of these things. And so it just takes a little time for Fannie to quote it. And once they quote it, they essentially give the quote back to that lender, and that lender can close on the deal as long as it meets all those criteria that it has. And so Fannie Mae is a little different than Freddie, whereas Freddie, they want to approve the deal up front before you get the loan application, and they want to approve it at the very end. On the Fannie side, I think a couple of the other things that they're looking at is, they're seeing a lot more deals where they're in lease up and they just can't quite get to that 90%. Let's say it's, 60, 70% occupied, and then the next couple of months, you're going to lease it up to 90 or, within 6 months. Then we're seeing Fannie do a lot more near stabilization deals. And Fannie did about $12 billion in the first quarter of this year, and they've got, I think, capacity to do 73. So they've got room, and I think the second quarter will probably be higher than the first quarter. But they're seeing overall loan spreads still be pretty tight. We're still seeing pretty good pricing.
What does that mean? I know that we locked a number of transactions this week.
Yeah, I mean, if you look at the base rate, so the base rate on a lot of these deals, whether it might be the 5-year treasury on a 5-year deal. So you take the base rate and then you add a spread. And that spread is essentially the lender's, profit in the deal. And the tighter it is usually based off of the competition or the number of people who are willing to lend against that asset. There's a lot of money in the market still on the debt side. So whether it's CMBS or these bridge loans, so we're seeing it still be pretty tight in terms of spreads. I mean, it did increase a little bit there with all the uncertainty with tariffs and what have you, but we're still seeing people sort of in that 5.5 range, I think is a good number, probably on your 7 and 10-year stuff. But on the 5-year stuff, you're in the low 5s or even high 4s, just depending on when you locked. A lot of people, they usually try to call us when the 10-year treasury drops below 4, and they're like, can I lock the rate? And it's like, no, you're not in position. So the most important thing is if you're relatively close, let's say it's $1 million plus or minus your loan balance, and you need to be in position. So you need to get third parties done. You need to have the borrower sort of underwritten at a high level. And then when rates do drop, then you're able to call us and say, let's hit the button and lock the rate. There's been many deals that were sort of kicked around for the last 9 months. And every couple months we get a new T12 and check it and see where we're at and compare it to the rates. And if it worked, we would go ahead and lock the rate. And if it didn't work, we just wait another couple months.
That's right. Are you seeing a lot of interest-only loans out there? And tell me a little bit about some of the restrictions that interest-only loans have with Fannie Mae.
Yeah, usually we're seeing probably on 5, you're usually able to get about 2 to 3 years. So it's usually about half of the loan term. So on 7, we're seeing a lot of 4 years interest only. And then on 10, we're seeing a lot of 5 year. But then if you do go lower leverage, let's say under 65, you could potentially get full term IO. So that helps because a lot of these deals, I mean, like I think it was last week, Marcus and Millichap had a call and they were like, look, a lot of these deals, it might not necessarily be, the cash flow might not be great because essentially you're sitting on, let's say you're buying a deal at 5.5 cap, and your debt is 5 to 5.5. So your leverage is essentially neutral or a little bit positive, but your cash on cash isn't going to be great right now. And majority of these A deals are getting bought based off of replacement cost or a discount to replacement cost. And so that's how a lot of these institutional guys are getting comfortable with it right now. And a lot of those deals are still getting done. Once the deal starts amortizing, your cash on cash is going to get worse if you did not move your NOI significantly. So getting full term IO definitely helps in that regard.
I've heard this. I don't know if this is the case. Can you get a 35-year amortization on those? I'm going to put these air quotes in there, on the right type of deals. And what does that have to look like to get a 35-year amortization with Fannie Mae?
Yeah, so I think it's more around the sizing, right? As you look at, let's say, a 125 debt service coverage, they are calculating that 125 not on interest only. They're calculating based on a 30-year AM. Like we were looking at a deal right now, and on 30-year AM, it was like maybe a $32 million loan. But then on 35-year AM, you could qualify for probably closer to 35. So it added, $2.5 million in loan proceeds. But both of the deals got full term IO. So it never came into, you were never going to pay down the loan, but it was more just the sizing of the loan. Fannie is doing that a little bit more as it competes with Freddie, and it's usually on newer assets. So let's say in the last 5 to 10 years in terms of construction, and then the borrower, Freddie has what they call a select sponsor. Fannie, I don't know what they call it, but someone who's done a lot of business with Fannie and done well, then they would give that 35-year AM because it is more risk, right? So they are basically, they're sticking to a 125, but they're lowering that debt service coverage hurdle a little bit so that you can get more loan proceeds.
Let's pull the curtain back a little bit about both Fannie and Freddie, and then we'll jump over to Freddie. Any more stringency on some of the, not so much underwriting, but maybe the physical needs of the property? What are we seeing on, we live in Texas, and Texas has these wacky soils that they expand and they contract and they expand and they contract, and all of a sudden the property that's been on the ground for 50 years, that's gone through 50 summers of hot and 50 cold winters, the soils have some issues, and that causes foundation issues, which causes mortar cracks. That may cause slippages of windows not being able to close or doors not being able to open. And so talk to me a little bit about what you're seeing, the level of Fannie and Freddie kind of getting a little bit more into the weeds with structural engineer reports.
I mean, I think everyone was always holding their breath until they get the engineer report anyways. But now people are just expecting it to be quite challenging. On these Fannie and Freddie transactions, you have a third party go out there, take a look at the asset, and then come back with a couple things. One is immediate repairs that they want you to take care of before they close, and then immediate repairs after, let's say, 60 to 90 days. And then they also put together a capital reserve schedule for the next 10 years or 12 years, whatever your loan is. And that's going to determine your replacement reserve. And as Fannie and Freddie have cracked down more on physical property, physical asset condition, it's become a lot more stringent. And some of these engineers, they might just say, hey, we need you to engage a third party for the foundation or get a third party on the roof, or if there's a larger issue that they just don't. I was on Friday I walked like 30 units with property inspector. And I mean, this guy was not gonna, I mean, after 30 units and 5 hours in the sun, this guy was done. Like he was not, he wasn't getting on the roof. He wasn't going to go out there and figure out the foundation or go
Sure.
look for termites or any of that stuff. So, I mean, these guys are doing their best to look at 10% of the units while they're out there and then putting together a report in less than 2 weeks. And I think your job as a borrower, and we've had a couple borrowers who have done this, is when you are under contract on a new deal and doing due diligence, is get all your vendors, get everybody out there, and essentially have all the reports ready to go. So if Fannie or Freddie if they do come back with, hey, what about this? Whether it's foundation, whether it's the roof, whether it's windows, whether it's parking lot, you have a bid for everything, right? And it's not necessarily saying that you're going to have to do everything, right? Because if you send a roofer out there, 9 times out of 10, it needs a new roof, right? So it doesn't, they're not going to make you do everything,
Sure.
but just have your reports ready because we've seen a lot stricter requirements on property condition.
Let's jump over to Fannie, over to Freddie. Any things that are popping out in your mind with Freddie Mac?
Yeah, I mean, it's a little bit of the same, but I would probably on the Freddie Mac SBL side, we've done a little bit more just because smaller deals have been easier to sort of get the equity for nowadays. And with Freddie SBL, you lock the rate right at application. So it takes a little bit of the risk out of the deal. But there's been a very big push on your schedule of real estate, whether you're an LP or GP in a lot of these deals, looking at sort of lower debt service, upcoming maturities, and sort of what your role in those deals is important. And then also making sure that, I mean, this was less of an issue when deals were 95 to 100% occupied. We didn't really worry about dropping below 90% physical. But if the market is 90% right now and your property slips to 88, 87, 85, all of a sudden you've got a problem on collections and this deal can't even qualify for agency anymore. So making sure the seller keeps the foot on the gas in terms of leasing and don't move the staff over to your other properties just because you're under contract. Because we saw one deal that was under contract for 6 months while the guy was raising equity. So make sure that your staff is in place till this thing closes, because if it doesn't hit 90%, really for the last 90 days, all of a sudden your buyer is going to be upside down or not be able to do the agency loan. And guess what? They're going to have to pay a lot more for a bridge loan, and they're coming back to you for a retrade on these deals.
The Freddie Mac SBL is probably a pretty good loan for people that want to get into the business, so to speak. Hopefully you have another partner that may have some multifamily ownership or management experience that you can partner on with them. But I'm more concerned right now. We talked a little bit about this foundation issues, but just the general overall condition of the properties, whether it is burned down interior units or it is just the overall condition of the asset, where it could be the alligatoring of the parking lot, a roof issue, the electrical issues sometimes on these properties, that the property with Fannie Mae or Freddie Mac, they are stabilized lenders. They are not bridge lenders. So if you think that this property is going to have some issues because of the condition of the asset, even though the numbers may reflect that it's in pretty good shape, we would also probably tell you or advise you maybe the better choice is to do a bridge loan initially, get the property fixed, fix all the deferred maintenance on the property, fix all maybe the plumbing on the property, fix all the down units on the property, fix all the old electrical systems first, fix all the things that they're going to have problems with to pass an inspection with a property condition assessment report that Fannie Mae is going to come on the property. You may want to do either a non-recourse bridge loan, but I would probably recommend maybe just a regular bank loan. I think we've seen a lot of people coming back to just using bank loans these days, James, instead of using non-recourse bridge loans. I mean, hell, if you make a loan, you're going to pay it back, right? So we just want to get you comfortable again of thinking that maybe a bank loan may be something to consider instead of a Fannie Mae or Freddie Mac loan, just because of the condition of the asset.
Yeah, condition of the asset, and then also it might not qualify for the leverage that you want it to be. And especially on a smaller deal, let's say 1 to 3 million, the Freddie Mac SBL can be done, but it becomes quite onerous for the seller and the buyer on a, let's say a 30 or 40 unit deal. It's a lot of paperwork for that size deal, and it
As they
might be
would
more
say,
painful.
it's an ass kicking, as they would say in my vernacular as an old timer. What else are we missing here, James, of just bringing people up to speed about what's going on? What have you seen the last, say, 3 or 4 weeks that you would think would be helpful for some people to just recognize of some of the issues that are out there?
Yeah, I mean, I think there's been less deals that have come out on the market, I would say, in the last month compared to the first quarter. But a lot of these deals that were listed, let's say in the last 6 months, some of those deals are falling out, and some of those deals never got set in the first place. What we're seeing is the call for offers might have been in April, and then, they picked a horse, they went to PSA, and then that guy backed out. And then now all of a sudden you've been 30 days since the last tour, but we need to go back to somebody else and find someone to take this deal over, just because right now there's just less buyers in the market. And so we're seeing people get awarded deals, and now all of a sudden they were number one on 2 or 3 deals. And now they're focusing their efforts on one raise, and so they're not going to go out and try to do 2 deals at once. And so you're having to sort of go back to the drawing board. And so I would say for anybody who's looking at deals, I mean, stay in touch with guys who are in the market. Obviously, we're in it day in and day out, but then also get out touring deals with brokers and let them know sort of your buy box and what you're looking for, because a lot of deals right now that are getting set are because you had a conversation or you had a tour with a broker and they heard about a deal that fell out after 6 months, and now you're getting a call. They've got to trust that you're going to pick up the ball and run it all the way to the finish line. So make sure that you're in constant communication, I would say, with your equity, and making sure, sort of what their box is what you're looking for.
So similar to you in the last week or two, I've been on a number of calls where a borrower put in an LOI, a letter of intent, to the investment salesperson, the person selling a property on behalf of a seller. They firmed it up, and now it's time to talk and meet over the phone with the seller. The seller is going to try to size you up as the buyer to kind of figure out if you're the right buyer for them to do. It's going to come down to these days is you having the ability to raise equity. The debt's available to try to get it out there, but the ability to raise equity is so critical. So the questions that I'm having, I'm going to throw it over to James here in a second or two on the recent calls with the seller calls, buyer-seller calls, is that if you think you could raise $10 million, probably be better to find a property that you only need to raise $4 million or $5 million. I mean, James, you guys just won a deal where the buyer got under contract and it was held for X amount of months, and they just couldn't raise enough equity to buy the deal. It wasn't your buyer, but it was where you who represent the new buyer came in and had the equity all put together, but they walked away, the previous buyer walked away with losing $1 million. So if you think you can raise $9-10 million, go with the property that you only need to raise $4 or $5 million, and be overconfident that you can raise the $4 or $5 million bucks.
Yeah, and have a couple million in your bank also, just in case you're short that $5 million bucks, just to be safe.
That's my point, is that you got to be more than what you would think normally capitalized on these deals. And so have enough money for the down payment, the equity into the deal, but also money for a rainy day, for reserves and things. Because that's what has been a problem for a lot of folks that took out these bridge loans, that there was no additional capital in these deals for a rainy day. So be overly capitalized on the deal, or just get the confidence that you could get the capital from your investors if you needed it in the future. All right, James, any final comments or things that we should be talking about that people that are fairly new or want to get into this business, what they should be knowing?
Yeah, I think there's a lot of a lot of news out there, and one day it's up, one day it's down, and one day we're going to have a recession, one day we're not. And so I think it is challenging. So a lot of people are just sort of frozen right now. And I think the best thing to do really is to, review deals as they come across, but then also if a deal is close, right? So if the whisper price is, let's say 10 million, and you're like, well, I'm only at 8 or 9, I would go ahead and tour that deal and put your offer where you think you can make the deal happen. And what we're seeing is a lot of these deals are coming back to people who are still hanging around after a couple months. And so, focus on growing your investor base, I would say, is number one, like you mentioned. But then also you've got to get out and go on tours and meet people at these deals, because we're seeing less and less tours on these deals. And so I think if, it's hard to be remembered when a broker does 50 tours, he doesn't want to be out there anymore. But, right now, let's say they're doing 10 tours, they're going to remember all 10 people. And if you don't win that deal, then there's probably another deal that broker will show you. So
are you physically going out there, James, with potential buyers and walking these deals? I mean, a lot of people think like this is like residential lending, is that you find the property and then all of a sudden you call 3 or 4 different residential 1 to 4 loan officers out there to try to get the best rate possible. Talk to folks that don't have any idea how this actually works.
Yeah, I mean, usually what we'll do is let's say you have a deal sent to you, you underwrite it, you're like, okay, this might work. And then you send it over to us and we'll give you what we think can actually be done. So what can be done on Fannie, Freddie, bank, or bridge. And then you sort of plug that into your model. If it works, then we'll set up a tour and we'll be on the tour with you and walk the property with you. And more than likely, if it's here in Dallas, we will have either financed that deal or the deal across the street or the deal around the corner. And so we can give you a pretty good idea of who your owners are or who your neighbors are in that market, and then tell you about some of the maybe physical aspects of the deal that we know about, and then who can finance that deal the best. And, sort of having us out there also brings the level of credibility to you as a buyer in terms of we've done numerous deals with all these brokers. And so
James shows up, the instant credibility in the eyes of the investment salespeople goes up huge.
Yes.
An old capital person comes on the property with you. In the eyes of the investment salespeople, your credibility goes up huge. So make sure you engage. Again, shameless plug, but you want to have us on the property tours at the beginning, not at the end, but at the beginning of these transactions. Anything more, James?
That's right. That's it.
So again, we appreciate everybody listening and spending some time with us today. This kind of a hodgepodge of different ideas that we're coming across these days. Don't forget to sign up for the Old Capital Conference coming up here in the fall. This is, again, where you're going to meet your next partner. You're going to understand what's going on with property management, what's going on with lending. You're going to understand a little bit about who's in the marketplace itself, and meet the best investment salespeople that are in the Dallas-Fort Worth, Austin, maybe San Antonio marketplaces too, that you can develop a relationship with. So again, unfortunately, Michael Becker couldn't make it today, but we are so blessed to have the Professor James Eng in the podcast today. So James, thank you very much. Appreciate it. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.